Right, so markets near all-time highs. Some investors are worried about valuations being stretched. Our guest says energy stocks still look like good value. And let's get his thoughts also on Cenovus's acquisition of Meg Energy. We're joined by Patrick O'Rourke, Managing Director, Equity Research at ATB Capital Markets. Patrick, thanks very much indeed for joining us.
Thanks for having me, Andy.
Start off with oil. It hasn't been a great year for crude prices, but we've had some good news in the shape of extra takeout capacity for the Canadian market with the Trans Mountain expansion.
Yeah, WCS differentials have been one of the good news stories out there. We've been calling for $60 crude prices in 2026, sort of starting to thaw that view. I think if you look at a dovish position from the Fed here, what that could do, they're kind of softening the stance on inflation here. Could that stimulate some demand? So that would be the front end of the crude trade here. And then at the equities level, hard assets, Canadian assets in particular, with the long duration of the oil sands, you could see capital flow to them as a longer term inflation hedge. So we like the setup on that side here today.
Talk to us about Cenovus and Meg. Did Cenovus get a good deal here, as analysts seem to think?
The industrial logic of this deal is very, very sound. Obviously, it's not across the goal line yet. There is a competing offer from Strathcona. That Strathcona offer would have been in the money when the Cenovus deal was announced. Today, the Cenovus deal looks a little bit more advantageous. There are some sort of tax considerations. There's differentials between the equity and the cash component of those two deals. But certainly, the Cenovus Meg merger or acquisition of those assets is something that's been talked about for about a decade. Mm-hmm. Those assets fit hand in glove. Cenovus is obviously very, very strong in terms of its oil sands operations, probably one of the strongest out there. Mm-hmm. They had a very impressive technical day during Stampede that we attended. So we think the logic here from an industrial combination standpoint is very sound. We are fairly constructive and have been on Cenovus. The downstream unit in the U.S. appears to be turning the corner at this point in time. Mm-hmm. And now you've added more oil leverage to the company as well.
Would you be a buyer of Cenovus at current levels?
Yeah, if this deal goes through in its current form, we see it as about 6.5% accretive to 2026 cash flow per share. We see the stock trading at about a 30% discount to our intrinsic value of the combined entity and about a 9% free cash flow yield to EV in 2026. So we do see some compelling value here.
Switch to natural gas, if you would. It hasn't been a great year for natural gas. I think there was optimism that the advent of LNG Canada would tighten up the Alberta gas market, but it doesn't seem to have done that much yet.
Yeah, LNG Canada has been a little bit slow in the ramp. I actually sent out a write-up to our clients last night. There is, some optimism here, a bit of an uptick in activity. It's difficult to sort of triangulate. If you look at the flows that sort of Bloomberg would be reporting into the facility, I think they understate the volumes there. There's some non-metered flows that are going into Coastal GasLink. So what we've been doing is sort of trying to triangulate the daily volumes based on the ship loadings. And those ship loadings we're happening about once every 10 days in sort of the start of August. That has shortened to about once every 5 days with the most recent loading over the weekend here. And that would sort of imply that flows into the facility have gone from in the range of 4 to 450 million a day up to 700 million a day. And, we're starting to see a little bit of response in the AECO basis curve here. There's been a pretty heavy maintenance cycle through the NGTL system, through the East Gate, but also something that's a bit under the radar here is that the West Gate, which is the western egress out of the basin, flows into a system called GTN. And today we're down about a BCF in terms of takeaway through the Kings Gate into GTN. We see maintenance there through October, but as we get into the November, December timeframe, and if LNG Canada, continues to perform and improve the performance on sort of the trajectory it's moving here, we think basis could tighten to in the range of $1.10 US per MCF into the winter. Today, that quote will be somewhere in the range of $1.40 to $1.50. So we do see a little bit of upside for Canadian gas prices here.
One thing I'm curious about is Tourmaline. It's the go-to on natural gas for a lot of investors. The stock is down this year. Can you tell us what you or your team, what the rating is on Tourmaline?
Yeah, we're outperform rated on Tourmaline. We're fairly constructive on the long-term view here for the company. I think what's happened is they've acquired a number of assets over the last 12 months. I think the market was looking for what the ultimate strategy for that was going to be. They released that with Q2. It was an incremental growth strategy above and beyond what the plan would have been before. Growth has been out of vogue for investors in the energy space, and that put a little bit of pressure on the stock. We see that as a de-risking event for the stock. Over the next couple of years, if you own this and you come out the other side of this growth project that they have in BC, we think you're going to be pretty well positioned like what you have.
Before we let you go, Patrick, anything in the market, any other stories you think that have been underplayed, or do you think there's any surprises that could be coming investors' way over the next few months?
I mean, we see the potential for perhaps oil prices to outperform a little bit into the end of the year. We talked about the dovishness of the Fed, but we're watching OPEC crude loadings. Saudi loadings in September were flat month over month. They had been expected to pick up as the cooling demand kind of waned there. We'll watch them into October. And then diesel markets. We're watching diesel markets very closely here. Diesel inventories in the US are very, very low. You've seen drone attacks in Russia. So we think that diesel could tighten into the end of the year, especially if economic activity picks up.
John Kemp of Reuters is reporting that he's seeing record bearishness towards US crude, and funds now have gone to a bearish net short of 11 million barrels of oil. So I guess that could be, people could scramble to cover if there's a catalyst pushing oil higher.
Yeah, I mean, I think there's a saying, buy when there's blood in the streets.
Yes, that's right. Thank you very much, Patrick. Talk soon. Patrick O'Rourke, Managing Director, Equity Research at ATB Capital Markets.